Welcome back to the new video, and this video we are on chapter 17, that is option on stock indices. So we will cover what is option on stock indices, how they are different, and dividend, how the dividend is calculated in this chapter. This video will be also very short video, and I hope you like the explanation. Let's go to our board without any delay. So stock option chapter 17. Right. So on indices, stock option on indices. So indices is exchange. You can think like as a ETF. So it is made by exchange. It is made by exchange and it is a benchmark to track a market, track whole financial market or a sector, industry sector like defense, IT, export import. So there are benchmark on the whole market like NSC, National Stock Exchange, that consists of NSC 50, Nifty 50. Nifty 50 consists of top 50 company of India from every sector. The Nasdaq 100 consists of 100 American company and it is a European type option. Gives Nasdaq 100 is a benchmark, which and there is a European type of option on Nasdaq. There is many benchmark like um, XPX, Chicago Board of Exchange have a on S&P 100 have a benchmark on S&P 100, that is OEX, XCO. There is a European option on S&P 500 and Dow Jones Industrial Average, TJX, and many more. You get the idea. So here it is settled in cash, and each contract is 100 times of index, 100 times of it index. So what that mean, if let's say we have a call option, its payoff would be x minus k into 100 and it will be in cash. So there is no buying or keeping the stock. The we will get the exact amount of money that is our profit, multiply of index, 100 index, right? And if it is a put option, the writer would give this much money to investor, right? That's the simple, and it is used for portfolio insurance. So portfolio insurance, let's say you are a fund manager and handling millions of dollars of fund, and your fund give beta of have a beta value of 1. The beta value of 1 means that if you invest the money, the return of money given by his portfolio exactly match the return if he invested in a benchmark indices or S&P 500. So let's say for India, the if the portfolio manager have a beta of 1, and that means that it ha so it means that the portfolio mirrors the return of portfolio of manager mirrors the return of global market or S&P 500 or Nifty 50, right? And yeah, so you understood the beta value. So this Nifty 50 benchmark help us in insurance or hedging. Let's say you are fund manager who have a $500,000 and you want to, and the index is at 1,000, right? And you The spot price is SO upon 100 because the one stock have a 100 times the price of index. So you want to ensure that your minimum value doesn't drop from 4 4 4500 45,000, no, 4,000, 450 right? 450 so you will you what so you need 500. So portfolio is worth 500 times the index, right? So if we have to hedge our position, so we will buy five put option with strike price of 900, and if the price goes below 900, so our total payoff would be 5 into, let's say price goes to 880, right? And that is 900 minus 880 and in 200 total amount of value, right? And that would be 10,000, right? And our loss, if the price is 880 gone down to 880, is our current portfolio value would be 440, right? I am right. 44, right? So we have to maintain our balance, right? We wanted our minimum value of portfolio not less than $450,000. So the total payoff from put option is 10,000, right? We are in the money, and the total value of portfolio would be around this. So in a way, we hedge our risk down bottom side downside risk, and that's how beta is value. Let's say if our portfolio beta is 2, that means it is double than index, right? It is giving better, so we have to buy 10 contract instead of 5. So its formula, it is like beta value into value of portfolio or total value of portfolio among contract size or index into con- contract size. So that the portfolio would be beta into value of our portfolio index into index time contract size. And in this way, if our value is 2, our portfolio what this much, and index is at 100, and that gives us 10 contract. So instead of 5, we would buy 10 contract, and that's simple it is. And we have to rebalance it with respect to time, because of this is stochastic calculus, it is stochastic value, right? And because of this also becomes stochastic. And yeah, so currency option, we discuss currency option in our chapter. It is just a brief introduction. So in OTC market, it is heavily traded, but on exchanges there are limited option for currency options. Still there is Nasdaq OMS that gives us what type of contract? I guess European core option, European type of option. It is not mentioned. Okay. So Nasdaq OMS gives a currency option. So there is a conver conversion rate. So the option is not on index, on what we say spot price. It is on conversion rate. Right? Say for $1, it is 1.5 pound. So our option would be on strike price of this conversion, beta spread of conversion spread. conversion value, sorry. So our K would be 1.5, and would be if $100 is equal to, it is wrong actually, the 1.5 pound equal to $100, but for understanding you can, it is 1500, right? 1500. Okay, that's how it work. And yeah, exchange rate, it is called exchange rate, not conversion rate. Exchange rate. And there is a contract size or a principal amount. You can set a total amount to be expenses into the conversion rate, let's say spot conversion rate minus our k equal to 1.2, 1.2 k. That would equal to profit of 50,000. 50,000 not, but let's say. So let's take an example of $100,000 into 1.15 minus 1.1, and that gives a profit of 50,000. And that's how the currency option hedge our risk for currency exchange rate going up and going down, let's say. So basic example we looked in our chapter number 2 was, if we are in US and we know we will receive some sterling pound in future. So to, let's say, to secure us from exchange rate going down, we would buy a put option, right? So let's say sterling is going at 1.5 and we buy a put of 1.4, right? And so we will, if the price is below 1.4, we will get this, sorry, we will use this strike price, and if it is 10, we will use the spot price. That how simple. And if we know we will pay in future, so we will buy call option to insure us from paying more, right? It is kind of insurance. So let's say that it is 1.5 and in 6 months the price could be 1.7. So if it is 1.7, we have to pay more. So we will use 1.5 as a strike spot price, and 1.7 minus 1.5, 100, contract size equal to profit. And that's how it work. And let's see hedging using forward. So for forward there is no charge involved, right? Enter. But for option there is charge involved. So what can we do, right? So this charge could be more, right? Because we are having the put and the strike price closer to spot price, and call price wronger than, sorry, call price wronger near the spot price. So the premium would be high. To nullify the premium and to ensure us the best hedging, we do the combination of trading or combination of contracts, right? So the one of the famous is first going, so first selling put option. So selling put option at K1. So we sell the put option at K1, right? And buying call option at K2, that is here it is K1 at K2. So here it is K2 and K2 would be like this. So our total payoff would be something like that. So what is the benefit of doing this? You here you can see there is no premium. So this is done right. We will choose the strike price K1 and K2 the such that its premium is equal. So from K1 short put we earn premium of K1 and premium of premium 1, and from K2 we pay premium 2. So in this way our total premium is 0 and it is called as a short and wrong position. A is short position, and if we want think the market will go up, so we will be in wrong position. So we will first buy a call option from K1 and then sell the K2 put option. Yeah, that's how. And the K1 is K1 would it will be between the spot price, and in this way we can we can pay enter into a contract with zero premium. And yeah, so if exchange rate is below K1, so we will exercise our put option. If between K1 and K2 we will use our spot price, we will do nothing, and if K2 it is greater than K2 we will exercise our call option. And in this way we can earn a profit with the index, currency index and currency option. So like dividend paying stock, index also pay yield, dividend yield. So we can use dividend yield like a we can use the or price the index option like a dividend paying option with slightly few changes. Like let's say we know that dividend is adjusted into stock price. Like if dividend is announced, the price go down by, let's say dividend is announced Q, so price go down by e raised to minus Q, right? So we can write the write non-dividend stock like at ST it would be S at the rate of SOE minus QP. So yeah, we can discount it like this. So the thing to remember is first if the SO provide dividend yield at the rate of Q, then the stock price with no dividend pay is SOE minus QT. So it is rightly simple. So let's take an example. If dividend is of 2%, right? So we will discount it at and the spot price is at 50. So before plugging this value in BS formula, so we will discount it by this factor. So 50 into E 0.02 minus into time, let's say 1 year. So the value would be could 48.0 something. So this value will be our new spot price, and this value we will put in our BS formula, and that will gives us a fair value or option that pay dividend. So in simple word, we discount the dividend yield from our spot price and then put in our Black Scholes formula to discount it. And in this way, or the lower bound, and so the lower bound of sorry, would be simple max and SOE minus QT minus KE minus RT. So this term look complicated. It's just the discounted value of 50. Let's remember 50 and discount it by with 2% of dividend, that is 48. So this value is 48. That's it. Nothing complex in it. It is simple, and to put core parity would be discounted value of our spot price. That would be same E plus spot with the spot price with discounted dividend. That is our put call parity, and the pricing formula BS formula is same. Only the change would be SOE minus QT. So we will plug the discounted value in our BS formula, and that's it. It is different, and the valuation, the risk free, the differential equation will be also same. Only instead of R there will be R minus Q, because our total is 5%. Let's say total dividend return in risk interval is 5%. So the dividend is counted in 5% of our return. So we will just minus the R minus Q. So our final differential equation would be plus R minus Q S delta S plus half sigma square S square second order term, right, equal to RF. And that's it. And valuation of index option, and I told you how to value the index option. So spot price, discounted yield, will put in BS, and that will give us a fair value of contract. And anything I left, yeah, forward by estimation. And in earlier chapter, let's say for our forward FO is SOER minus QT. We covered this in chapter. R is our risk free rate and Q is our dividend. So the core option on forward would be forward price V1 minus discounted forward price, right? We have to discount it. Just it's simple discounting, nothing anything complex, and simple BS formula. Okay, and anything I left. And the currency option, okay, now we are on valuation of currency option. So in currency option there is RF, RD. RD is domestic, what we say, sorry, domestic risk free rate, and RF is risk free rate of foreign currency, or a currency we are converting or exchanging into foreign currency. So the pricing is exactly same. So instead of discounting by dividend, we will discount by RF. So our final value would be SO discounted minus RF into T. That's it. Instead of Q, we write we will put our risk free rate of foreign currency, and the pricing would be done in similar option. And forward exchange rate, right? So if forward exchange rate is here then our equation become RD minus RF upon T. RD is domestic rate and RF is foreign rate. And yeah, American option can be done using our binomial model, and with with a value, just the a value be RD minus RF, and everything would be same. That's the core concept. That's all the concept of this chapter, option stock and index currency. It is very small chapter. I hope you like this and practice the solution, and if any doubt and any suggestion about the video, you can comment it down, and I'm very happy to read your all comment. So bye bye, have a nice day, see you in the next video.